Let's be honest about your morning ritual. You wake up, grab your coffee, unlock your phone, and open your brokerage app, and there it is. Green arrows. Another headline screaming S&P 500 hits record high. For the people already in the market, this is a champagne moment. But for you, if you were sitting on a pile of cash, maybe 5 grand, maybe 50 grand, this is actually a nightmare. You feel paralyzed. Buying stocks right now feels like showing up to a party at 2 a.m. just as the house lights turn on and the cops show up. You tell yourself the same lie you told yourself last month. I'm just going to wait for a 10% dip. I want a deal. I'm not a sucker who buys the top. And while you've been telling yourself that, the market climbed another 15%. You were suffering from the sucker's dilemma. You were terrified of looking stupid by buying the peak, so instead, you're looking stupid by making 0% returns while inflation eats your cash alive. Clears throat. You think the market is fragile because it's high, but history suggests the exact opposite. Let's look at a statistic that should keep the bears awake at night. As of right now, the Federal Reserve is in a rate-cutting cycle. Usually the Fed cuts rates because the economy is crashing, but this time they are cutting rates while the stock market is at record highs. This is rare. It's what we call a celebratory cut. Carson Research looked at every single time this has happened since the 1980s. When the Fed cuts rates and the market is near an all-time high, the stock market was higher 1 year later 20 out of 20 times. That is a 100% win rate. The average return, nearly 14%. Why? Because you were pouring gasoline, easy money, onto a fire that is already burning hot. So we have established that the macro machine is effectively rigged to go up. If the smartest economists at the Federal Reserve are fueling the market, why do you think you know something they don't? But I know what you're thinking. Okay, the system works, but I don't want to be the unlucky person who buys on the one bad day. Let's get personal. Let's look at a legendary study from Charles Schwab that simulates the lives of 5 different investors over a 20-year period. This will prove once and for all whether timing actually matters. The setup is simple. 5 people. Each has $2,000 to invest once a year for 20 years. Contestant 1 is Perfect Peter. Peter is a god. He has a crystal ball. Every single year, he invests his $2,000 on the absolute lowest day of the market. He times the bottom perfectly for 20 years straight. Contestant 2 is Ashley. Ashley is lazy. She invests her $2,000 on the first day of the year. She doesn't look at charts. She just buys immediately. Contestant 3 is Rotten Rosie. Rosie has the worst luck in human history. She invests her $2,000 on the absolute highest peak of the market every single year. She buys the top every time. And contestant 4 is Larry. Larry is scared. He keeps his money in treasury bills because he's waiting for a crash that never feels cheap enough to buy. Who won? Obviously, Perfect Peter won. He ended up with about $186,000. But here is the shocker. Ashley, the lazy investor who just bought immediately, ended up with roughly $166,000. She was only about 10% behind the guy with the crystal ball. She did zero work, had zero stress, and got almost the same result. Now look at Rotten Rosie, the woman who bought the top every single year, the sucker. She ended up with $151,000. Even with the worst possible timing, the compounding growth of the market saved her. And Larry, the guy who stayed in cash waiting for a better entry point, he ended up with approximately $54,000. Look at those numbers. $151,000 for the sucker who bought the top versus $54,000 for the genius who stayed safe in cash. The person with the absolute worst timing in history outperformed the cash hoarder by nearly 3 times. The lesson is brutal but simple. The penalty for being out of the market is infinitely higher than the penalty for buying at a bad price. Rosie participated. Larry watched. In the U.S. financial system, participants get paid, and spectators get taxed by inflation. Okay, so the math says buy, but your stomach says vomit. I get it. We're biological creatures, not calculators. So how do we fix the fear? 1. The 2035 mental shift. Stop looking at the 2024 chart. If you buy today, you aren't buying for next Tuesday. You are buying for 2035. The top of 2015 looks like a bargain basement today. The top of today will look like a steal in a decade. 2. Hack your brain with DCA. If you have $10,000 in cash and you're scared to dump it all in at the all-time high, don't. Split it up. Invest $2,000 a month for 5 months. Why? Because this hacks your psychology. If the market goes up, you're happy because you bought some. If the market goes down, you're happy because you get to buy the next chunk cheaper. Dollar cost averaging isn't just a strategy, it's anxiety medication. A stock market at an all-time high is like a mountain climber standing on a new peak. Just because they are high up doesn't mean they're about to fall off the cliff. It usually means they have found a higher floor to build the next base camp. The Federal Reserve is cutting rates. Corporate earnings are growing. And Rotten Rosie proves that even if you are wrong about the timing, you are right about the asset class. Stop waiting for the crash. The crash might happen or it might not happen for another 5 years, by which time the market will have doubled again. The only crash guaranteed to ruin your financial future is the crash of your purchasing power while you sit in cash. Don't be Larry. Be Rosie. Just be invested.